Hi, my name is Dion Rebello, and this is the Bullion Vault. Hi, Willem, how you doing?
Well, in yourself, Dion.
Good. So this is episode 34.
I believe so.
Yes. So I think we've had some nice momentum. I mean, to think that we've literally done a podcast every single week since end
Since
of December.
January,
Yeah,
I think we had a break in December. We had
that's
one or two
correct.
before that, and then yeah, since January, it's pretty much been one a week.
Well, congratulations. We need to pop some bubbly for that at some stage. I think when we get to episode 50, which we coming on and coming on quite quickly. So just running into it, I mean, it's been an interesting week in the markets. We're talking about gold hitting another all-time high. It broke the 3,500 and it's currently sitting at 3,530 odd dollars an ounce.
Yeah, I think interesting is a bit of an understatement. I mean, last time we saw it break 3,500, it was sort of a blip, and then it was down again. This time it's hanging around there. It's been over 3,500 for a day or two.
Yeah.
And yeah, it's very interesting. I mean, silver's up over $41 an ounce. Platinum sitting at over 1,400 an ounce. It's yeah, the metals are really shining at the moment.
Excuse the pun. But you say that, and it's quite interesting. I mean, as you mentioned, silver is over the $40 mark. We're now going into that territory where we've said all along, silver starts to head towards 50. We're going to completely uncharted territory. But again, we look at the current conditions of the global markets, and it does speak to massive uncertainty. And kind of what we're going to be discussing today in this episode is pretty much focusing on the US because it is the biggest economy in the world. And the old adage where when the US gets a cold or sneezes, the rest of the world gets a cold. I think that's kind of poignant to what we're going to discuss today.
Definitely. I mean, if we take a look at the metal prices at the moment, well, firstly, let's take a look at the gold silver ratio. I mean, we were talking about it being over 100 a few days or a few months ago, and now I think one of the ones I saw recently was it was sitting at 85.
Yeah.
And as I said way back then, it's going to close, but it's not going to be because gold is getting cheaper. And here we're sitting with an all-time high gold price, and that gold silver ratio has closed. Now that's the first thing. Now the second thing is, why is it so high? Now there's obviously a bunch of reasons, and as you said, the US is a big influencer in this space. And at the moment, they've got the Federal Reserve meeting coming up to decide on the rate cuts in a few, I don't know, a few days, a few weeks, soon. Let's just call it soon. And there is at the moment, I think they betting on about a 90% probability of 25 basis points cut on the what do you call it? Oh goodness, the interest rate. Sorry,
Interest.
I couldn't find that. I had reserve in my mind somehow, but yeah. So that's one of the biggest things at the moment, and I mean we can see massive pressure from the government, actually from the White House, to make that rate cut happen.
And what's interesting here, and I think it's actually on Thursday that they will be having that Fed meeting, and then either the announcement of an increase or remains the same or a decrease. But again, I think the important thing is that, as you said, there's a lot of pressure coming politically. Donald Trump came into government making a lot of big promises, and he is determined to turn the economy around. We've gone into big at length and discussed the U.S. economy, the concept of what he's trying to do there. Stimulated by increasing tariffs, which forces internal manufacturing and that. But again, we're talking about industries that have been dormant and non-existing for more than 2, 3 decades. Now, suddenly to reestablish that, we've spoken about the cost with that. But what's interesting is there is a definite push from the White House on the Fed and specifically on Powell to start having some more influence within that institution.
Yeah, I mean, you look at them. Basically, Trump's come out and just fired Lisa Cook for I think it's something about lying on her lease application or on a home loan application or something like that. I don't know the full story, but basically they're coming back and they're saying, no, it's unconstitutional. So now there's a court case and now nobody knows what's happening. You know, we've had a ruling from the courts earlier this week that basically they're saying most of Trump's tariffs are illegal and they should not be allowed to stand. Now that's getting pushed through to the higher courts. Eventually, it's going to end up in the Supreme Court, which is stacked with 6 Republican-appointed judges, 3 of them by Trump himself. So, yeah, but, basically what I'm trying to say is we don't know what the heck is going on. Nobody knows what the heck is going on at the moment, and that is one of the big things that is fueling this increase in prices in the gold price as a safe haven asset. Uncertainty just guides people to buy gold, and I think that's one of the big things that's happening here as well.
Yeah, you talk of a world that is very uncertain right now, and especially when a lot of economies take their direction from the US and especially within the Western world. Of course, we've had the whole formation of BRICS, and there's a lot of rallying. There's a lot of with regards to the tariffs. I mean, even us as a country, we've been subjected to very high tariffs because there's a clear way of trying to manipulate or push an agenda. So either play with us nicely or we'll put 30% on everything.
Yeah, I mean, it's not thinly veiled, let me put it that way. Basically, if you look at some of the developing economies, 3 of the highest tariffs has been placed on Brazil, India, South
South
Africa,
Africa.
which is 3 of the BRICS nations, or three of the letters in BRICS.
Yes.
So it's not a secret, and I mean the man himself has stood there and said BRICS is a threat to U.S. Sovereignty. What do you get the
Yes.
idea? It's a national
Security
security
issue.
issue. Big tariffs for you. So it's not that they're being subtle about it. I mean, yeah, it's their prerogative to put tariffs on whoever, but it's sometimes I'm thinking just a little bit more common sense about the whole thing. You don't need to destroy the entire world to try and make a point, and we don't even know what point they're trying to make.
I'm smiling for a very, very specific reason because I think common sense and Donald Trump don't fit in the same sentence. And quite frankly, being a supporter or non-supporter, it's irrelevant because you got an individual that is now ahead of the most powerful country on the planet, and whatever they're doing has massive ripple effects on everyone else. But now I want to go into the US economy. So let's start to actually unpack that because what's come through over this last week is some very scary things. Now, since probably 2018, 2019, we were talking about a black swan event. In other words, within the stock markets, it's been on the cards from 2018, 2019 that at some point we were going to have a massive transferring of wealth, either via a massive a recession, depression, or some form of a market correction. So let's just unpack some of the data that we've had. And I mean, there's always good ways of starting with the one of the most famous people within stock markets and investing is of course Warren Buffett.
Yes, and he of course has what we call the Buffett indicator. And basically what that is, it measures the stock market to GDP ratio. And according to that, you can tell exactly how well it is valued. Anything over 100% is considered to be overvalued. And if you look at where it is today, you actually swallow your socks because it is sitting at 217%.
Okay, so let's just unpack that. So it's basically taking the stock market value over the GDP of the United States, correct?
Yes, and then of course that gives us an indication of how exactly things are valued.
Okay, so and as you said, and based on the Buffett indicator, anything above 100% is considered to be overvalued. So we're sitting at right now a Buffett indicator at 217%. So let's just be clear here. It's not like 120%. We're talking 217%.
And even more scary, compare if we look at past events, big events, for instance, the dot-com bubble, it was sitting at 150%. If we look at the 1929 Great Depression, during the peak of that, it was sitting at 90%. So it gives you an indication of just how far out of whack it currently is. And now that, of course, begs the question, or if we look at previous events, it fell 50% in 2000, it fell 89% in 1929, and as I said, that begs the question: is this about to happen again?
And the important thing here is if we look at it, we're not talking about 150%, we're talking 217%. And if we go back and we look at former recessions, depressions, over extended periods within the US, some of them were a bubble, which is an overvaluation of that specific sector. So, for instance, 1929 was a stock market bubble. I think 2000, the next one was.
And it was 2001 was the dot-com bubble.
Correct. And that was also stock market based.
Okay, well, let's just go back and take a look at these two events. So 1929, there was excess bank credit being generated, and it was obviously to support the First World War. Then in the 1930s, that supply contracted, the market collapsed, and that's when we saw the money supply fall and the stock market fell 89%. So the root cause of the crisis was the creation of that massive, massive credit and then a contraction.
Yeah.
So during the dot-com bubble, basically what happened was, US was the place to invest. It was the start of the internet. It was the start of all of these companies being created, the dot-com billionaire companies, etc., etc. And there was massive, massive investment into these companies. And the thing was, nobody knew exactly what these companies were going to do. It was unprecedented. They were the first of their kind. Nobody knew what they were going to generate, but everyone was expecting big things. So there was a massive investment in them. And then, as it turned out, they didn't generate all that much revenue.
And so what you're essentially saying here also, again, is there was a massive overvaluation within the stock market. Come 2008, that was very much a housing or real estate bubble. And again, that was what caused that massive drop. But what's interesting now, and we've seen the S&P 500, which we've spoken about at length on this, where over the last 2-3 years, I think it was in 2023, it hit 52 all-time highs through that year and has not slowed down. I mean, if we see the performance of the S&P 500 last year and again this year, it has continually and consistently increased and grown in value. And for anyone that doesn't know, as you know, is the S&P 500 is basically a barometer and a gauge of not necessarily the top 500 companies within the US stock market, but there's a weighting and gauging. But basically, the top 500 companies categorized in percentages and so on. But that is an indication, and we've said this before. COVID-19 was very clear where with all the quantitative easing, where we were not working, where literally cities were shut down, there was a massive drop in performance, and yet a lot of these companies were declaring massive growth, massive profits. And again, we always pointed towards this quantitative easing, which was forcing this bubble. And as I said earlier, this is from 2018, 2019. We already started to see there were issues within those markets. Suddenly 2020 comes in, COVID kicks in, and that accelerated it. I mean, we've spoken at length about this. In 2020, of all the dollars ever produced, 21% of all dollars ever produced were produced in 2020. So we got a lot of 20s there. But the fact is, to qualify that, all the dollars produced since I think it was 1926 when the dollar came into being, or in the early 20s, until 2020. 1 year takes up a fifth, literally, of all the dollars ever produced in 1 year.
It's actually frightening, and I mean, we're looking at this money being printed, and why is it so important to have all this money flooding in? And that brings us back to the question I asked earlier of, with 217%, are we looking at another stock market crash? And the answer is no, because this time it's a little bit different. If we take a look at the stock market, and we'll see that people who own stocks drive 50% of consumer spending. So that, of course, fuels corporate sales. And if we look at the stock market, if stocks go down, people have less to spend. Stocks, corporate spending goes down, and then, of course, the economy slips into a recession. So, what they say here is the top 10% of people own 90% of the stocks, and their spending depends heavily on rising stock prices. So, no matter what, they're going to keep those stock prices up. They are doing their absolute best to keep the stock prices up, to keep the spending up, and they've become masters at this. Had they known how to do this in 1929, it probably wouldn't have crashed. Had they known how to do this in 2001, it probably wouldn't have crashed. And that's the thing. They've become experts at injecting money into the system, basically just printing billions and billions, and buying themselves or printing themselves out of trouble.
And what's interesting is, so you're talking about the stock market, and what we're building up to is, we've mentioned the previous recessions, depressions. So what makes where we are right now more alarming is it's not just the stock markets, it's also the real estate market, which, I mean, here's statistics. The real estate data is alarming. Home sellers are outnumbered buyers by nearly 500,000, which is the biggest gap ever recorded. The median homeowner's age has risen to 56. Meanwhile, the mortgage delinquency rate has already reached 2011 levels before recession has even started.
It is a very, very tricky situation at the moment, to say the least. I mean, if we look at the US debt, there was this interesting article where it said, if you made $500,000 a day, so $500,000 a day, every day since the Great Pyramids were built.
So we're talking 3,000 years?
We're talking a long time, and we're talking millions and billions of dollars. So anyway, if you made $500,000 a day since the Great Pyramids were built, you would have made less than what the US government has borrowed since July.
Okay, so just to qualify that, we are in the beginning of September. So we're talking from July, August, literally, so 2 months worth of refinancing of their debt and securing further loans. Just repeat that.
If you made $500,000
A day.
Since the Great Pyramids were built.
So that's over 3,000 years ago.
You would have made less than what the US government has borrowed since July.
Okay, so now let's just unpack this, and this is what's quite interesting when we start to go into these numbers, is let's talk American economy. So the national debt has passed over 37 trillion. Again, I think what we need to do is go and break down what a million, billion, and trillion is. And I remember we did it in the sake of seconds, where we used that just to explain the difference, because these numbers are used so loosely when it comes to money. Like we got Elon Musk, and we got all these guys that are billion and trillionaires. But there's a big difference between a trillion and a billion and a million.
It is. It's actually quite frightening if you think about it. We talk about millions, we talk about billions, we talk about trillions, and I think the biggest thing is, most of us can't really actually fathom how much money that is.
Okay, so let's break it up to that example. So let's talk about something that's tangible. Let's talk about time.
Okay, so let's start with 1,000,000 seconds.
Okay, which equals?
11.5 days.
Okay,
Not a lot
so
of time.
1,000,000 seconds is 11.5 days.
Pretty much. And but I think, most of us can sort of get our head around exactly what $1,000,000 or R1,000,000 is.
Correct.
What it can buy. It's a more tangible number. We can sort of picture what it can buy. I mean, I can see a nice little car these days, which is quite sad, is what
I
a
was
million
gonna
rand
say,
can buy.
exactly. So,
A small little house, maybe, not both,
yeah.
not both, but we sort of have a clear idea of what R1,000,000 can buy. So it's not that abstract a number. Now we move on to 1 billion, and once again we take 1 billion seconds. Now, we talk about Elon Musk with his, I don't know what he has at the moment, 400 odd $billion.
Yeah, I was gonna say it's around $400 to $500 billion.
It's quite a lot. Now, I think this is where it starts becoming a bit more abstract. You think, oh, $1 billion, that's a lot, but you don't really understand how much it is, because let's go back to the million seconds, and as we said, that's 11.5 days. Now we move up to 1 billion, and suddenly that becomes 31.7 years.
Okay, so 30.17 years, right?
Yeah.
Okay, so we've gone from 11.5 days on 1,000,000 to 1 billion, which is 31.1 years,
1.7
0.7 years. Okay,
And
that's pretty much 2/3 of my life.
So yeah, that's why I'm saying, this where it starts becoming abstract, because you think you can fathom what $1 billion can buy or R1,000,000,000 can buy, but it's really, really difficult. That little car that we talked about, you can buy pretty much any car you want. You can buy just about any house you want, and you wouldn't have made much of a dent to that billion.
Yeah.
So that's the thing. It's a different. You already sort of start losing perception here, and then of course we move on to a trillion.
Okay, so let's just to sum up everything. 1,000,000 is 11.5 days. 1 billion is 31.7 years. 1 trillion is, drum roll,
31,709 years.
so it's 31,000.
709 years. Comma 8 if you really want to be finicky about it.
So again, this is the important thing, is we get thrown these numbers with money, and as you say, I think with money we kind of don't see that how big it is. So this is now concerning. So we've broken down, so just to round it off again, because it's important, $1,000,000 is 11.5 days, $1 billion is 31.7 years, and $1 trillion is 31,709 years. So there's a big difference there. Now let's talk money. Let's talk US. Let's talk debt. Let's talk just the interest on their debt right now.
And we literally just finished telling you how much a trillion is. Interest alone costs the US over $1 trillion per year. That's not paying back yet. That's not paying somebody to actually handle all of this. No public services included, none funded. $1 trillion per year just on interest.
Again, this reminds me of our own country, where we literally, for every rand we produce, 20 odd cents is going to service the interest on our loans. And America is also in massive trouble.
Well, this is the thing, they've got a much bigger debt to GDP ratio than we have. Their economy can carry it. So they just keep borrowing, and people are very happy to lend them money because they feel secure that money can be paid back.
So this is also what's interesting, is by 2033, which we are now, what?
7-8 years away.
8 years out, or 7.5 years out from. What's interesting there is the debt will hit $55 trillion, and nearly half of all the tax revenue eaten by interest alone.
That is frightening numbers. I mean, and they say Social Security's largest trust fund is projected to run dry at the same year. Foreign buyers are quietly dumping US treasuries in favor of gold because the trust that they have in that dollar is waning a bit. And we've seen the dollar take a hit lately. Its value has gone down. It's sort of rebounded over the past 2 or 3 days. But the interesting thing is the price of gold. Usually when the dollar rebounds, the price of gold goes down. And it's not happened this time. The price of gold has kept up. And that's also a very interesting thing to notice, because it just shows you that there's a bigger trust in gold than there is in the US dollar for a lot of investors at the moment.
Well, it's very clear. I mean, we know that US bonds, the treasuries are not being purchased. There's been a shift away from them into gold. So a lot of your institutional investors are now considering gold as a safe haven instrument. We've been talking about this for years. I mean, we could have got it for them at a better price if they'd actually listened 5 years ago.
It's actually quite interesting. I was working something out yesterday, and basically what it came down to was the gold price in August last year versus August this year. Now, it was on the 31st of August 2024. The gold price was 44,643 rands per ounce, which, we saw and we looked at and we went, wow, that's high. This year, it's 60,866 rands an ounce. And I mean, right now, it's probably much, much higher than that. So that was an increase of 36.34% in the space of a year.
Yeah.
36%. And then we looked at, did the same thing with silver and platinum. Silver, it was 521 rands per ounce, roughly round about there. And this year, it was 701 rand. That is 34.6% increase over the space of a year. And then lastly, platinum, which was 16,479 rands an ounce last year, August. And this year it's sitting at 24,065 rands an ounce with 46% increase.
So, I mean, that's quite interesting. So, again, we did say platinum has been to date this year to date, the top performer. That confirms that, in fact, if we talk year to date from the end of August last year to where we are now, I mean, those numbers are credible. I'd be interested to see what stock or within any market has been competing or creating that kind of a return on investment to those numbers.
I mean, yeah, it's and we've done that little interesting little exercise of ours where we compare the the gold, an investment in gold versus
An
a
RA,
retirement
yes.
annuity. And just the other day you sent me a message saying you'd be interested to hear, well, to see where this is sitting at the moment. And it's quite frightening to say the least. This was before gold reached 3,500. It was sitting at 3,469 rand,
Yes.
round about there an ounce. And I had a quick look at it. We were looking at $214,000, 819 rands invested in the RA, and it was valued, the latest one we have, at 330,707 rand. So that is an increase of 53.9%. Not too shabby.
Over 15 years.
Over 15 years.
Yeah.
All right. So now we looked at the same thing in dollar terms. Now this is where it's always come short, is in terms of dollars versus rands. The dollar is always underperformed. I mean, we've seen negative numbers on this very exercise in the past. And at the moment, believe it or not, we're sitting with a 16.2% increase. But you mentioned 16 years, right?
Yes.
And so let's look at the compound annual growth rate. We're looking, in terms of dollars, we've got 0.95%.
Yeah.
In terms of rands, we've got 2.7%.
Yeah.
Which is not exactly somebody would be proud to put in his portfolio, let's be
No,
honest.
but now, okay, so let's get to the real crux of what you're highlighting here. So we've spoken about the performance of the rand in relation to the dollar. Yes, over the performance of the full period of this case study, which is my personal RA, which is fully verifiable. Um, you've given the numbers. So it's grown, it's been okay. It's not been a big song and dance. Of course, when they sell it to you, they say it's going to grow at this and it's going to do this and do that per annum and all of that.
They say it could.
Yes, and there's always an asterisk there, and you know they are subjected to the performance within the markets, as we will also say, because these are things that are fluid, that are moving up and down literally as we speak.
I mean, it's 100% understandable why it performs the way it does, etc., etc. I mean, nobody's to blame for that. They give you a best case scenario. You go, yes, that sounds good, and you buy into it. However, if we take a look at gold, you know, we done the same thing, and by now you would have accumulated 305 grams of gold, which is 9.78 ounces. And the latest, well, not the latest, this was done, when was it? Because this was actually done on the 1st of September. So at that stage, gold was sitting at $3,469 an ounce, and you would have had 599,606 rands worth of gold. And just the cherry on the top, you would have had 33,952 US dollars worth of gold. And if we look at the growth on that, that is 110.68% increase in US dollars, and it's 179% increase in rands.
It's phenomenal. I mean, you know, again, and this model and this case study is based on monthly accumulation. So it's not an outright purchase, and it's amounts that are based off what I would be paying on my RA. I think originally it was around 1,000 rand, 800 rand originally. I think it's sitting at about probably 1,700 rand there and thereabout. You know, and that's monthly accruing, monthly growing. And again, this case study, we took that into consideration. We applied a percentage for the physical gold for manufacture. So it wasn't just based off spot price. In fact, if we had just used spot price as the indicator or the barometer, these prices would have been even higher. So this is a very much a real world case study scenario.
Very much so. And, you know, it comes back to that all important compound annual growth rate, the CAGR on these numbers. And if we actually look at the growth of gold on those, in dollar terms, we're looking at 4.77%. In rands, we're looking at 6.63%. Now, you know, now we're getting somewhere. You know, we're not looking at 0.95 and 2.7% anymore, which, let's face it, that's below inflation. You're actually losing money.
Yeah.
So that's basically the difference. And that's why we always say, we're not saying dump all of this, forget about it, it's not worth it. We're saying diversify. Diversify your portfolio. If you're in this for the long haul, look at some precious metals. And that's always what we're trying to say is, this isn't a pump and dump. This isn't, I'm going to grab some gold, I'm going to sell it next year for 40% profit, which you could have done. We've proven it here.
But that again, and we really need to stress this, is gold is a long, especially physical gold is a long-term purchase. You're not buying today to sell tomorrow. Yes, over this last year, you would have made your money back and some, but that is extraordinary.
Definitely. And yes, as I was saying, you could have, but don't, because it's not going to suddenly go down. Yes, we do see the dips in the market every time it hits these all-time highs, purely because of that, purely because of profit taking. People who bought some gold last year, they're seeing these numbers and they're going, okay, now's the time to sell. But gold isn't a one-shot deal. It's not going to hit that high price once and then never again. We see that gold price growing over time. You know, a few years ago, if we told you it's going to hit $2,000 an ounce, you would have said you're mad.
Yeah.
It's hit that. It's past that. We have forgotten about that low price of
Well,
$2,000 an ounce.
Realistically, and I know that there were a couple of institutional investors, the JP Morgans and Goldman Sachs of those kind of companies, where they had to and we've done this on previous episodes, where they had to recalibrate their projections. And there are a couple of them that are coming out saying $4,000 is now on the radar. And the fact that we smashed 3,500, and as you said, it wasn't like it did before where it broke and then there was a recovery, there's a profit taking. It's broken and it's now leveled and it's now holding there. Same with silver, it broke 40 and it's now holding. Same with platinum, it's broken the 1.4, it's now holding.
And yeah, it's, I mean, I think it'll probably dip below that again.
Yeah,
It will dip
absolutely.
Below 3,500 again. But it's a much stronger 3,500. The previous time we saw it and we went, oh yeah, there's the peak, it's coming down. It did come down, but not a lot.
No.
And now it's broken that 3,500. It's sitting there. And I read earlier today an article where somebody is talking about we're probably going to see 3,750 this year.
Year end, absolutely. I think I was on those projections. We need to go and check previous shows, but I think I did.
I'm a little scared to go and check that out because I think I was a little low.
Yeah, I know you were on the conservative side, but I think I was, based on what we were looking at, and again, when we do a lot of this, there's a lot of research done. We look at the market, we look at market commentators, both from the general public, but also institutions. We look at government, we look at reserve banks, we see exactly what's going on. Then we kind of make a call exactly where it is. But I think I didn't say that we'd break 3.5, and I do remember saying that it probably we'd get probably a peak around 3.7. I do foresee that we've created a new resistant line. So we've broken that 3.5. It probably will drop under 3, sit around 3.4, but I can't see it going down to 3.2. The interesting thing is we've just moved that up. It's gone into the new step. And it's like with the rand and the dollar. I always say you get those peaks, it breaks it through. So suddenly there's not this fear of the market. That's a new price. It's impossible, it won't get there. Suddenly we now know that it's possible. And that slowly then is met with the resistant line that comes there. And that's when that new bracket is taken. And that's where the prices then start to hold at higher levels.
I think I want to coin a new term here. It's I don't know exactly what to say, but it's basically all-time high fatigue might be kicking in a little bit here. We saw this all-time high and we saw $3,200 and that was the baseline. Now it's gone up to 3,300. Now it seems it's moved up to at least 3,400. And as you said, there's not a massive surprise anymore when it does break that 3,500. And it just blipped above 3,501 like last time. It was 3,540 it touched on.
Yeah.
It's a massive jump up. And as I said, I think this all-time high fatigue is sort of setting in. So every time it goes up, it's not a shock anymore. And there's this massive sell-off and the dip afterwards, it sort of starts to even out. It starts to settle down at those prices. And that's when we see that support level moving up at the bottom all the time.
So just to recap, and I mean, the main focus of today's podcast was the US economy, was the debt with regards to the Buffett indicator, which we've said is in new territory. We've touched on the S&P 500. We've touched on the stock markets, the overvaluation bubble there. We've touched on the housing market and the overvaluation bubble there. Now, the person that's listening to this, it's kind of a scary place to be. Before we even started this podcast, I'd said to you, we've spoken about this for the last 5 years, but now to start see it happening in real time, it does become a little bit nervy because the knock-on effects, the ramifications of what we're actually talking about is not just numbers. It's real people in real lives that something is going to hit the markets and something's going to have a massive shift in where their wealth is held. So, on that note, and we're going to just wrap it up, is what in this situation is the best answer? What's the best solution for someone listening out thinking, this is scary?
Well, it's quite simple. Firstly, diversify. You know, anything you have that you can spare, diversify. Get it out of fiat currencies like the rand, like the dollar, etc., etc., and precious metals is simply the easiest way to do that. I mean, geez, I was looking at some crypto the other day, and it was quite funny. I thought, let's pull a joke and buy a Dogecoin or something stupid like that because they cost next to nothing. My goodness, I couldn't manage to do it. I couldn't set up a wallet and this, that, and eventually I
And you
just gave
tech
up.
savvy, by the way.
And
So,
eventually
so
I just gave up.
I'm actually surprised to hear this.
I think it's more a case of I don't trust it enough.
And that's the thing. I've also said, and don't get me wrong, we're going on to a different subject here, but cryptos, blockchain technology, I think is exceptionally relevant in the world we're in. So not for a second am I knocking the technology, but it is a diversification of it, and it is definitely an option if you've got the means and but for me personally, there is a part that intangible bit that's kind of a little bit unnerving.
I think it's more a case of, you don't know. I mean, we've recently had I won't call it a cyber attack, but a hack on a bank account within our realm lately. And, going on, opening a wallet, putting all of your payment info in there, you don't even know where it's going. You're dealing with a bunch of foreign payment processes, you entering your personal bank information in there, and you don't really know what's going on. And I just didn't trust that, and that's eventually where I said, that's it, pull the plug, I'm out of this. So yeah, that is the problem with crypto. Unless you go to somebody and have them set it up for you, which is going to cost you money, of course, and you're going to be spending money before you even get something. And especially if you just want to do it as a bit of a joke or as a long shot.
Let's see, yes.
Yeah, as the guys who bought 1,000 Bitcoin for $5 back in the day, and those type of things. It's just so difficult, and that's the difference between crypto and bullion at the moment. You can literally walk into any shopping mall in the country,
In the world.
and there's going to be somebody selling some form of bullion.
And also this is, again, as I said, cryptos and blockchain has its place. And if you've got the appetite, it's an alternative point of investing. It's also taking away from fiat currencies and so on. So we're not saying, again, it's about doing due diligence. It's about spending the time making sure. The difference with gold and bullion is it's been with man from literally the inception of when we first started trading. We traded in silver and gold for ivory, for pepper, for things that, the world slowly started to build itself up as a global economy.
Yeah, I mean, it was literally money.
Yeah.
And it still is to a certain degree. We read about an interesting little article that we shared earlier about why can't you buy a cup of coffee with gold. And maybe we'll go into that next time because we're running very short on time here. But basically, what we're trying to say is diversify your assets. If you investor that has a more established portfolio, make sure that you've got assets outside of fiat currencies like gold. I mean, even in that scenario, some crypto. But just for the every man on the street, we've proven you can build quite a nice little nest egg just by paying a smaller monthly premium every month. Just by doing that consistently, stacking, getting those grams of gold, silver, whatever you want to invest in. And I think that's the most important thing is, firstly, it's not impossible. Secondly, with some patience, you can actually make a real difference.
And just in closing, Willem, I think it's so important that people do their due diligence. Again, this is about information, and what we're saying is not law. We're not financial
Advisors.
advisors. But the important thing here is we live in life. We got all the challenges that most people have, and we're living in economies where inflation's increasing, food is getting more expensive, everything's getting expensive, and we're just looking at options and ways to literally lessen that blow. Now, based on the research, based on what we've spoken about today, it's clear that bullion, gold, silver, and platinum has a place somewhere within what you're buying. And again, like Willem said, there are many, many ways to go and purchase it, from grams, from fractionals, from you name it. There is something available there. And all we're really saying now is there is a big thing coming. We don't know. We've spoken at length about it before, but we are now into uncharted territory, globally, economically. And this is the point where when these things do break, when there is this massive recession, depression, and hopefully it doesn't come, but based on what we've discussed today, it's now highly more likely than not. And all I can say with that is make sure that you've got some exposure into bullion. Make sure that you go and look for ways to at least mitigate some of that risk, that when the markets do crash, when all these things start to happen, suddenly there's going to be a massive surge. I mean, then we're talking at gold $6,000 an ounce. We would talk it in numbers that would blow our minds. We even say it now, it sounds crazy. But the fact is, we have a massive market recession, correction, depression, that gold overnight could shoot to those numbers and levels with ease.
Yeah, you know the way you're talking, you're making it sound extremely scary and a massive upheaval of world powers and whatever. But I think it's going to be a bit more gentle than that. I think there's a lot of smart people out there who knows exactly what's happening, who has put some form of preparation in place to prevent this from literally destroying the world as we know it.
Well, I hope you're right, because for me, I am an optimist by nature. But for me, it's concerning. Again, like I said, we've spoken about this for more than 5 years.
It is concerning.
Yeah.
Yeah, stuff is going to happen, but I think it's. I don't think it's going to be as revolutionary, or it's difficult to explain. It's going to be sort of the lava flowing out and resurfacing the landscape versus half of Mount Vesuvius is gone.
Well, I'm gonna hope that is the situation. Willem, thanks for your time. And just in closing, if you got any final thoughts.
Thanks a lot, Dion. And if you guys enjoyed the video, leave a like. If you want to see more, hit the subscribe button, and we'll see you in the next one.
Bye bye.